Hey guys, welcome to another video today. Hope you guys are good, hope you guys are blessed and staying safe. Today I'm bringing you a video on what to do with your money, what you should invest in after you save your first £1,000, or if you might be older, so you might have saved £1,000 or more already, but what should you put your money into? How can you make your money work for you? What should you invest in? What ETFs should you put your money into? Bonds, just how to make your money make you more money after saving your first £1,000. Anyway, let's get into the video. Do drop a like if you like the content, and do subscribe if you would like to see more content like this. Cool, let's get right into it. First thing you should do is pay off your debts. This is the best way to get the best returns. And what do I mean by this? If you have a credit card with an interest rate of 10%, 15% or even higher, paying this off immediately gives you the highest return possible. Because if you fail to pay this and you get charged more, not only does it affect your credit score, it also means now you owe more money rather than you gaining money. So ideally, you want to pay off your debts first, whatever that might be, whatever price it is. Just try to pay off at least the minimum so you don't get charged even more. But the second thing you should now do with the £1,000 that you have is that you should invest in yourself. Investing in yourself is very, very important. This can either be paying yourself, paying yourself after you get your monthly income, weekly income. Just pay yourself at least. Try not to spend 15%, over 15% of your income. In my opinion, you want to try to save as much as possible. Pay whatever debts you have and everything. You want to try to do that, but don't spend over 15% on yourself or anything that isn't really worth it. But you want to invest in yourself you can buy a book which you can read to help you make more money. I'll show you guys an example. Okay, so I've got this book which I've been reading it for a while. I've read it quite a bit now, but this is an example of a book you can read. It is called Money. It's called Money, right? And this pretty much teaches you everything about money. So tax rates, what stock market, what you can invest in, how money works, etc, etc, etc. But you can invest in yourself by simply buying a book such as this one. That way you can actually learn how to spend money. Learning about money and learning how money works is the easiest way to make sure money you use that money to actually make you more money rather than spending it in a useless way. A lot of us might feel like we know about money, but trust me, we don't. We make it and we lose it. But there's ways to avoid taxes. There's ways, and legally, of course, but there's ways to avoid taxes. There's ways to make your money actually, diversify, to make you more money from different areas to make sure you don't lose money. Now, the first thing you should do is for you to put an emergency fund aside. What is an emergency fund? So emergency fund is money you have. Ideally, you want to have it in cash, not too much money in case you lose it or anything like that. But ideally, you want emergency funds, which you have on you in case anything happens. So this emergency fund isn't for emergency food because you're hungry, or, emergency motive, cinema, whatever the case is. I would say you should have at least 50% of your expenses as an emergency fund. So if you're someone, if you do have, house bills to pay, phone bills to pay, shopping, food, or family, whatever the case is, try to save at least 50%. Of course, you're not going to save 50% from this £1,000 that you have, but try to work towards it. Build a foundation. You want to build this 50%, have it, so that way that could cover you for 6 months if anything is to happen. So until you get a new job, until things stabilize all over again. But you don't want to be caught in a situation where you have no money, you have to reach into your credit card, then you have more money to pay back, then that whole builds up and everything becomes chaotic. So make sure you save up an emergency fund that you can spend whenever you truly, truly need it. So the fourth thing you should do after you save up the emergency fund is that you can now invest in bonds. So you can put your money into bonds, which is kind of like a government setup. It's like a government loan. So the government loans your money or uses your money to help businesses that might need money, or other small companies, whatever the case is. You give them this money and it's stored somewhere, and you're not allowed to touch it for a certain amount of time. So different banks have different bonds set up, and this can be for 6 months, 1 year, 3 years, 5 years. But the longer it is, the more you kind of earn back. It's not going to give you the most amount of money. It might be up to like 5% return, but it's still money. Whilst your money's not doing anything for you, instead of leaving your money in an account, you could just put this into the bonds, and in the next couple of years, the government will pay the money back. There are other ways of doing this as well. So you're actually giving your money to smaller businesses, but these aren't as safe simply because it's not guaranteed that you get your money back. But it's the government, so you're most likely to get your money back. But other businesses and all these other, niche areas, you probably want to avoid those if you don't really have the money to risk. But usually the greater risk, the more reward. So if you do want to risk it, you will gain more back in the long term. Now the next thing you should do is invest in ETFs. So this is now my favorite parts, I guess. Invest in ETFs. So ETFs are...
I didn't catch that. Could you try again?
So you can invest in ETFs, and ETFs are stocks or companies, as a collection of companies, right? Which you can put your money into, and any broker put your money in there, and this could be the top 100, top 200 companies in the world, or whatever the case is. You put your money in there and you could just leave it, and this will slowly grow over time and over time. So these ETFs are basically where you can invest your money into with less risk, without even having to monitor it whatsoever. You can leave your money in there, you don't have to monitor it, and this just grows as the company grows. It could also go down, if the companies aren't doing well, but there isn't any individual stocks that you have to worry about. That's the whole purpose of the ETF. It could be the top 200 companies in the world. You put this in that ETF. So some examples are the S&P 500, which everyone already knows of. This is the top 100 or top 200 stocks in the world in this ETF. So we know tech obviously is one of the biggest out there. We have Tesla and all these others, and of course these are bound to do well. So you can also invest in tech ETFs, whereby the top tech companies are in these ETFs, and your money will just gradually increase as these companies continue to do well, without you having to do any work whatsoever. So these are just some examples of ETFs that you can also put your money into. You also have dividend ETF. So the top dividend ones, I also have some of these top dividend, put your money into those, and you get dividends back from all these companies, which you didn't exactly select, but they're the top companies, or the top returning or highest paying dividend companies are in these ETF, and you get these dividends quarterly. Some of them are monthly, but you get this throughout the year with less effort. Lastly, now with the remaining money that you have, you can put this into individual stocks. This is a bit more volatile. This is a bit more risky. So you could put, 20% of that 1,000 or 30%, however amount you have left. Now you can put this into the stock market. And some examples, you have Tesla, you have Apple, you have Amazon, you have Microsoft. These are big companies that are quite safe, because you're not really going to lose money, because they have so much money and they are bound to always do well. So we have Apple. You can remember years back, Apple was such a small company. Look at them now in a couple of years, in less than a decade. I mean, if you're still young as well, this is a perfect time to begin, making your money work for you, because you have time to work for you. You have a lot more time than, people who are much older to make your money work for you. For example, you can really make use of compound interest. So if you're to invest £200 per month, that's £50 per week, with an initial deposit of about £500 into the stock market, buy a couple individual stocks, and hopefully with a generous 10% return on the stock market in the space of 10 years. So assuming you're 20, by the time you're 30, you'd have invested around, if my math is correct, you'd have invested around, and this is with compound interest, so with an investment of about 20k-ish, you could have 40k back. If the stock market is generous and you get a 10% return. So that's literally double how much you put in. The more you gain back through dividend, the more you invest the dividend, the more that continues to build up and build up and build up and build up. So this is kind of my favorite way of investing, because there's also less tax as well. You can save, it's less than what you usually pay through your day-to-day jobs as well, through investing in dividends and your returns. Of course, they're taxing everything, but trust me, you save a lot more in doing this. So in the next 10 years you can literally save up to 40,000. By the age of you're like 30, that's about 10% of a mortgage. You can do a lot more with that, rather than you having that 20,000 just chilling in your bank account, not beating inflation or following the market basically. So ideally you want to aim to save about 50% of your income. You know, after paying your debts and everything, hopefully you've not inflated your lifestyle too much. So you want to hopefully at least save 50% of your income. Try to do something with this 50%. You can keep accumulating and keep increasing your emergency funds, put some into bonds. The key thing is you want to diversify. You know, if the energy sector goes down, you want to make sure you're backed up through tech and, you know, oil and other sections of the market basically. And you want to make sure you're not investing over 15%, so that way you're safe. If the tech completely crashes, you have the others to basically still back you up. So that way you want to make sure you diversify as much as possible in different ways of savings, because you know they all have a cap. So there's a certain amount in the stock market that you're protected by. So you want to make sure you don't put like $1 million into the stock markets. The stock market crashes or whatever, and you lose literally 90% of your money gone. So you want to make sure you put some into bonds, put some into the stock market, put some in your bank account to even get that 0.5% increase, whatever the case might be. But make sure you diversify. And if you guys would like to begin investing, you know, the links are below on Trading 212, which I am with. You can buy any stock of up to £1, and you can get any stocks of up to £100 back. Some of my friends have done this. They got like £60 just by investing £1, and you can literally get that £60, sell it, get your money, and leave if you really want to. But that aside, thank you guys for watching the video today. Hopefully that was helpful, that was beneficial. If you guys would like to see more content on investing, do let me know. But do subscribe once again. Do like the video. Stay blessed, stay safe.